Hello, and welcome to the Invest with Carl podcast. I'm Jamie Uppenberg, your host and a member of the Carl team. Today, we're chatting with Stephen Wu from Carthage Fund II. We'll ask the usual first questions about this fund, which is what makes it so successful, some fund history, and what's important for investors to know about wading into this fund. We are Carl, digitally offering unique investing and some hedge fund opportunities with often packaged in data-driven delivery to accredited investors. So we put the ease of investing in the palm of your hand in a mobile app. Carthage Fund II is an upcoming investment opportunity at Carl. For over 6 years, Stephen was an AI engineer at Amazon and Microsoft. He built the Alexa music recommendation system using probabilistic algorithms. He knows his math, which we get frequently here. He partnered with his closest friends at Citadel, Point 72, Neuberger Berman, Balyasny. He has lots of friends, so there's more, etc., to combine statistical modeling with financial analysis to create this strategy, Carthage Fund II. After over 4 years of consistent profits, he started the fund full time, and his whole personal net worth is invested in the fund alongside investors. So he is committed. Hi, Stephen. It's great to be chatting with you today.
Hey, thanks for having me.
All right. We always start with tell us what made Carthage Fund II strategy successful so far. Why do you keep it in your portfolio, which it sounds like you are 100% invested in this fund. So what makes you confident enough to do that?
Yeah, so after many years of experimenting with options, I actually found that this part of the options market is highly lucrative and risk adjusted. So on a risk adjusted basis, it's lucrative, but also has the least risk. So I found that instead of buying and holding a stock where you have to be directionally correct, it goes up or down. Every week we just bet it stays within a certain range. So instead of a couple of different option strategies that I experimented with in the past, this particular part makes consistent profit, and I'm able to consistently make profit every single week, every single month, so that our money can grow at 30 to 50% a year. And so over the past 4 years, I've been trading this strategy in my account, and I've been cutting out as much risk as possible. And so now we have this finalized version. So the finalized version, we only sell after events, after announcements, after earnings or FOMC, Fed. And so by only selling after events and betting it stays within the range during times when there's no expected announcements, that's how we can make the most profit and reduce the risk. So there's no expected announcements. The stock shouldn't make a new historical move statistically during a time when there's no news coming out.
Oh, that is really interesting. Okay. So if I'm hearing you right, if a stock doesn't have any, like no news is good news for you, you should
Exactly.
be able to more accurately predict what a stock is going to do. And it's not about whether it's going to be really high or move in some big way. It's more about being able to predict the movement within a range, right?
Exactly. Exactly. So for example, Workday has never dropped 17% in 5 days in history. And so during weeks when there's no announcements and nothing happening, I could sell 20-25% below current prices puts. And as long as it doesn't make a new historical movement, we should make our zero point 0.5 to 1%.
Wow. Okay. That's very interesting. And you've been running this for 4 years of consistent profits. Congratulations. I do want to let our investors know it is Carthage Fund II because it is based on the original fund that Stephen has, but as it comes onto the Carl platform, it becomes another entity. So there is no one other than the two. They're not different in any way. So this is based on his original fund, and it sounds like it's doing really well. So it sounds like Carthage is doing great. Could you talk about diversification? Like if you're saying you're 100% invested in this, it means you're not hedging any place else. So it sounds like the diversification is all in the options, and you don't care whether things are moving up or down. Is that right?
Exactly. So it, to be honest, it's very rare in my life where I'm so confident that I put everything into one thing. And as you understand why I can do this because in this portfolio, it's all of my money. So I diversify it as safe as possible. And here's some examples. So we sell options betting the range after volatile events, right? But the types of companies, like we used to trade China stocks, but then suddenly Jack Ma disappeared one day. Yeah, so I cut out all China stocks. I cut out, Tesla moves up and down 10% sometimes for no reason. or on a tweet, on
On a
Elon
tweet.
Musk.
Yeah.
So we only stick to software as a service, low debt, low multiple, just mega large cap names that are the safest and as most predictable as possible. Because I also use weekly credit card data, website traffic data, and app downloads to understand the health of the company. It's subscription based. So it's, unless something crazy happens, I could see it in the credit card data beforehand. Just understanding that the health of the company is pretty safe and stable, like Microsoft, Adobe, Intuit, Autodesk, these types of safe companies is what we trade.
And to that, it means that you don't care if things are going down because you're able to predict both sides of the market. So you feel fully diversified regardless of market movement.
Exactly. I don't care if it goes down or up, as long as it stays above or within that range that I set.
Range. It's almost like it can diversify itself in its own bubble of fun, which is what people love to hear. That's great, because you don't have to hold anything else to hedge the down market. And then obviously there's a lot of talk about funds, and actually it's interesting you talk about Tesla. I've been asked about Tesla various times over the years, and I'm always like, well, Tesla's a great investment, except those tweets.
Yeah.
Just, you just don't know what's going to happen on those days. So it's humorous you mentioned that. But with that, what do you see as technology, and what do you see the impact to investing from technology? I think you're one of those examples. Like, you came from the tech side and have come over to the investing side. What have you seen, and where do you think things are heading?
Exactly. With technology, we can have so much more visibility into these stocks and understand like what's happening. And actually, I also argue that with technology, for kind of the average investor, you can see some of the data that I see, but then it may be misleading. Like, if unless you have the full picture, one part of the company might impact revenue that might show up in earnings that you never predicted. But, just understanding the company and having sell side research, algorithmic trading, and positioning and understanding what's happening is really important. So technology enables us to look deeper, as long as we still have the responsibility to make sure we understand fully what we're trading. So, like, for example, you can almost think of my fund as the opposite of quants, because algos purely use price history and statistics to trade options. But I use that, and we have scanners and all the, Black-Scholes algorithms. But an additional layer is understanding qualitatively what's happening. The CFO of ASML mentioned that they have so many orders in the backlog that if this whole year cancels, they can fill up this whole year with orders. So that's just the offhanded comment I listened to on a phone
Wow.
call. But understanding that, okay, earnings is sort of a safe event. The holders are long onlys, so they hold for 5 to 10 years. They don't sell quickly, versus
Got it.
hedge funds, they buy and sell quickly. So if you kind of understand what the health of a company is and listen to every single phone call, you can kind of know what range is safe to trade.
So it sounds like you're using both the technology and making sure, and we've talked about this in previous podcasts, there's so much data available that you
Yeah.
actually need someone with that type of data management tools to really sort through it. It sounds like you're adding that to still having regular qualitative, a human view on things to make sure you're not missing anything that the data won't see.
Yeah, and oftentimes these models, actually 80% of trading in the market is just algos. And these models are great in quantitative analysis, better than any human. But then with qualitative, it just doesn't fit. Like, the ASML orders numbers don't fit into the model of the statistical price history. So I think technology has done great, and those trading strategies do great for, they're right about 55% of the time over thousands of companies. So they're doing fantastic. But our fund, we're right about 99.2% of the time in our 50 to 100 companies that I specialize in. So
Right.
everywhere there's a niche. And if you find your niche and understand it well, then you can make profit.
Right, right. Really interesting. Okay. Let's see. We always go to risk controls. You've touched on them a little bit. But if investors are coming in, what do you do, and what assurances can you give them that you are paying attention to risk, and how are you managing it?
Absolutely. Again, this is my whole net worth. So every percent you see is my own percent return as well. So I have very, very strict risk parameters that I follow. Even if I think I'm right emotionally, I just cut losses as soon as possible. If we're making, 2 to 3% per month, then all I need to do is get out when things turn bad and we make money every single week, every month. It's not a big deal if we just are flat this week, right? Basically, this is what I'm doing all day in the fund. Wake up at 5 a.m., reading the news and understanding what is happening with our companies, making sure nothing surprising is coming out, no news, no sudden announcements. And if nothing happens, these companies should behave somewhat statistically normal and not make a new historical movement. If something does change, then I could quickly close it at either a small loss or flat and open it, rebalance to another name that's safer, that does not have the new risk. So every day I'm closing things, making things safer, opening new positions for next week, and just rebalancing it, taking profit when some things like the workday never dropped 17%. If it's up 3% the first day, then it has to drop 20% in 4 days. So then we could take 50% of the profit in one day and recycle that capital. So very efficient, very tight book. As soon as things turn sour, we get out. It's just as soon as possible.
And then you talked about also if you find a section that has an anomaly, it's acted differently than your model really works with, you just end the sector like China or Tesla, right?
Yeah, I
That's pretty
guess
big.
over the past 4 to 5 years, we've been cutting out things that have surprised us in the past. And we continue to, no one's perfect. There will be more surprises, but we continue to cut out as much as we can and what may surprise us. And we
Right.
just
And
found,
you're
yeah,
still spread out over whatever you had 50 companies, a little over 50 companies. That alone is pretty good diversification, right? I mean,
exactly. Each position would return like 0.5% returns each. So then over the
right.
course of the week, it should all,
Add
yeah,
up. Yeah.
yep,
But it also means if you're wrong on any one or two of them, the bulk
exactly.
should carry the weight. Yeah.
So if I'm wrong, I could cut that position and put on a new one, or I could, if let's say Workday drops and nothing has fundamentally changed about the company, I could cut that position and put on the following week for even more premium. So if it hasn't dropped 17% in 5 days, could it drop 40% in 10 days? Like, and nothing has changed about the company. These are the types of things I move out in time and I move across companies.
Interesting. Very interesting. So thank you so much for chatting today. And I'm sure we'll have more questions. Sometimes we're able to get a second podcast in. I hope I talk to you again soon. We often do that about risk, but we talked a little bit about risk here. So maybe we'll come up with some new topics for our folks. But do you have any final words about your fund? What would you tell someone who's just thinking about investing in Carthage?
Yeah, we welcome you with open arms. My philosophy is fully transparent, and Carl is a great platform that they can help answer any questions you have. We have a dashboard that shows your returns and also offer monthly liquidity. So to be honest, you can try it out and see if I do make this consistent return that I say I do. Let the results speak for themselves. And if you don't like it, we can withdraw next month. Not a big deal. But I just welcome you. My net worth is in this, my sister, my mom, and this is just see for yourself the results. And if you like it, add more. If you don't, you can withdraw. It's not a big deal.
Awesome. Stephen, thank you so much for joining us today. Investors, thank you for joining us for another episode of Invest with Carl, and we'll see you next time. Bye-bye now.
Thank you for listening to the Invest with Carl podcast. The views shared on this podcast do not necessarily reflect the views of Carl. This podcast is intended for informational purposes only and is not intended to constitute and should not be deemed to be an offer to sell or a solicitation of an offer to buy any security or investment, financial advisory, legal, tax, accounting, or other professional advice. Carl funds are currently available to accredited investors with a minimum investment of $20,000. To learn more about Carl and to download the Carl app, go to investwithcarl.com.